and
Hello.
we're going to hit him up with some really good questions, kind of a forward-looking view of 24 and opportunities. But before we do, Frank has a very interesting background in the real estate industry, having worked in some various aspects. Why don't you give a quick background about yourself, and then we'll dive into the questions.
Yeah, sure. So I'll give a quick background. As David mentioned, I'm Frank Forte with Lucern Capital Partners. Dave and I are partners, and I also serve as our Chief Investment Officer. So we've been at it, Dave and I, for the last 7 to 8 years. Had a really good run. Prior to that, I spent some time in banking and private equity with a company called Berkadia and another company called CW Capital. And we worked on the default of one of the largest residential properties in the world and the aftermath of that. And then prior to that, I'd worked in private equity in the senior housing space. And then prior to that, I was a consultant for the government after the financial crisis on failing banks. So I had a pretty good run, but the best run here so far. So thanks for the
And yet to
intro,
come.
Dave.
And yet
And
to
yet to come. And
Yeah.
yet to come. That's right.
All right. So without further ado, we'll dial in on these questions. Hopefully, Frank will share some good intel with you. Frank, so the interest rate environment, it's been wild to say the least. Um, how is this currently, where we stand now, impacting both buyers and sellers in the market?
Yeah, no, it's a great question. So I think it's put, it's turned transaction volume into a screeching halt, right? And I think everyone is trying to find their footing of where things are going to shake out. I would say in the last, I would think, month to 6 weeks, I feel like there's a lot of renewed optimism. Part of my job, right, is being on the phone almost 24/7, right? And David knows this, trying to stake down people for deals, talk about what's going on, see where there's opportunities, and kind of uncover that for our investors. So I speak with a lot of people per day, and I think I'm not alone in feeling that there is some renewed optimism that we are on kind of the back end of this interest rate hike cycle, and that things are going to start to moderate and come down. So when rates are uncertain, right, things kind of go to the wayside, right? And uncertainty makes for big bid ask spreads between buyers and sellers. I think you're now starting to see that kind of narrow in, that people are feeling a little bit more confident and certain, at least in their opinion, of where things are going to go. And so deal volume is picking up. But the last 2 years have been very slow. Last year in particular, I think for most people, including myself, was one of the slowest years we've had. Um, so short of it is, uncertainty and interest rates leads to a real significant slowdown in deal activity, but we're seeing it pick up, and optimism, which is almost as important as the rates itself, seem to be getting better.
Yeah. Yep, optimism plays a huge role in it, and public and sentiment amongst investors and other shops. Um, so what investment opportunities do you see that are going to be, as as a chief investment officer, what are you looking at? What do you see, and where are these opportunities across, the various commercial assets?
Yeah, no, it's a great question. I think we are going to see a return to cash flow. I think over the last 5, 6 years, it's been, a game, irrespective of asset class, buy it, fix it, sell it, right? And while you were doing that and executing your business plan, rates were coming down, so valuations were getting lifted. So in addition to the good work that you did on any business plan and you executed, you got some tailwinds and lift from the marketplace. Now that the marketplace is going to be flat and rates are going to come down, but you're not going to see the fervor you saw over the last few years. I think it's going to come down to cash flow, right? Back to basics on cash flow and management. So to that end, I think there are going to be opportunities in cash flow driven assets, which sounds funny to say as we talk about real estate, but anyone who's invested in multi over the last 5, 6 years knows cash flow could be a little bit of a mirage. And especially if you're a value add investor, every time you think you're going to get a little cash flow, you're pumping money back into the property, you're moving rents, and the value in the back end, holds up, right? But you don't ever get that distributable cash flow in a very material way through the life of the deal. And you end up seeing it manifest in the back end. Where we are focusing our efforts, and what's most interesting to me is a space called light industrial, flex industrial. Kind of, if you ever driven your car around and you see a little collection of warehouses or a couple buildings with roll-up doors where there's 5, 6, 10 tenants, and they're all operating, an HVAC business, a welder, a supply place, a pool store, any of those sorts of things. It's wide variety of tenants. It's diverse. It's kind of a sheltered cash flow stream, right? Because if one tenant goes out or turns over, not dissimilar to multifamily and apartments, all your eggs are not in that basket, so to speak. So you have diversity of cash flow. But more than that, I'm seeing a lot of parallels in that space that I saw and David saw in 16 and 17 in multi, right? Before the world rushed in, which is, hey, workforce housing. Back then, it was really hard to build. They weren't making any more of it. It was in high demand. It was well located. Expenses were easily controlled, which is now not the case anymore. But we're seeing that in this light industrial space. Properties are really tough to come by, in high demand from local tenants who have been priced out of larger warehouse. They're usually located in really nice areas, and operational costs can be kept in check. And then ultimately, through what's known as a triple net lease, you can offload that exposure to the tenant. So you're insulated, you have a good cash flow stream, debt is readily available for this product, albeit not being available for other asset classes currently. So that is the most exciting thing that we are passionate about right now. And there'll always be good opportunities, but I think cash flow investing and back to basics is going to be the theme of 24 and 25, sprinkled in with, special opportunities as they, present themselves.
Great. You kind of answered the next question, so we'll change it up a little bit. I mean, why don't you drill a little further down on that, and I'll put another question on the topic of light industrial. Like, why now? There's large format, there's large industrial, there's opportunity in retail, different opportunities in repositioning office. Like, why are you so focused on this right now?
Yeah, well, so I think there's a couple trends in the country right now, right? Trend one is on the industrial side. You've seen a lot of big box warehouse. Everyone has seen it no matter where you live. You drive down the highway, there's some big thing going up with sticks holding up big concrete walls, right? Tilt up construction, and you drive past it and they're 500,000 million square feet. It's Amazon, it's Chewy, it's Walmart, right? One of these big companies taking it. They represent such a small percentage of the overall businesses that are in America. And if you operate any sort of service business, you need a place to be and locate close enough to homes and your customers that you can get on a highway easily, you can access and service your customers easily. And most of what you need is a big warehouse space to store your items and distribute, and then a really small office space in the front that's for someone to answer phones, place orders, do accounting, reconciliation, so on and so forth. So you have this space is more and more in demand, and the supply of it is actually flat to shrinking. And it's flat to shrinking for a couple of reasons. Flat because the economics don't make sense to build it. It's too small of a building footprint. So with construction costs being elevated and material costs being elevated, it's really, really, really difficult to build something for a price that makes sense with prevailing rents. So that's thing one. And thing two is a lot of these properties over the years were actually flattened and raised, scraped even for bigger box stuff. So the supply's been going down. All the while, service businesses in the United States continue to grow, right? And small business is the backbone of America. So you have these really great supply demand structures in place. But why now is a good question. So we look for here at Lucern inflation hedge investments for our investors. It's one of the reasons multi's been so great for so long. The leases roll every year, right? David, you've seen this out there before, but when you see a big industrial building of Walmart, whatever, they're inking 10, 15, 20-year leases. A smaller tenant may be inking a 1 to 3 year lease. So you can get at the rent roll, so to speak, much quicker. You get a turn similar to apartments, and you're allowed to mark that rent to market much quicker. So you have an inflation hedge. You have this diversity and stability from the fact that 1 or 2 tenants go out one, they're easily replaced. The space is fairly universal in function. And two, they're not an overwhelming chunk of the rent roll, any one tenant. So it's a really positive thing. But last thing is, cap rates are still held up for this product. Every product we've bought at this has been a 7 cap or higher. I don't think anyone in the multi-space has heard the word 7 cap in a million years, right? Unless you're buying in, like Anchorage, Alaska. Right? I don't know. I'm sorry to throw shade at the people from Alaska, but some off place that you don't want to invest. With Flex, the cap rates have been higher traditionally. You could still find financing, and generally the tenants and the credit worthiness is actually pretty stable, much more stable than you'd expect. So it's exciting. It mirrors multi in a lot of ways and gives us that ability to hedge inflation and provide cash flow.
Great. So on the topic of multi, do you foresee opportunities coming about over the next year or two? And if so, what things would what does it look like, and what would give you pause to step back in on a multi deal if you would take pause?
Yeah, no, I think it's a good question. Listen, we're deal junkies at heart, right? Even though we're conservative underwriters and, we manage risk as appropriately as we can, we're still deal guys. And I would think the opportunity would have to be very compelling. Compelling from a sense of the tenant base would have to be strong, would have to be an area we know well, that we feel really confident in our projections. But I think more than anything, we'd have to be willing to weather the storm over the next few years. And what I mean by that is I think multi is going to be very difficult for the next couple of years. I think you have supply that's absolutely out of control, right? Any market you look, especially markets you want to be in, the supply is really, really high. You have rent growth that's been so strong for so long that folks just can't pay, right? Like you can throw around no one's got a place to live, housing shortage, blah, 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 as much as you want. At the end of the day, immigration is slowing. Household formation is down. You have people who are actually moving in with family members, brothers, sisters, friends, whatever, because they can't afford the rent. And you have inflation that's entirely out of control, even if it's begun to come down. Talk to any low income person, moderate income person that's out there. They're feeling the squeeze, right? They go to the supermarket, they can't make their bills, they're cutting back wherever they can. Some people are selling their second car, keeping one car. Everyone is squeezed. So the notion that you can just keep pushing rental growth on people, I think, is short-sighted, and we're going to see some really tepid rent growth as a result. And then you also have these other factors like payroll and cost of labor. Finding good people really become, unfortunately, very challenging post-COVID. Habitational insurance costs through the roof. So you have all these factors that really hurt. Anytime you move to the top line and these items increase and you don't have control or you can't pass those items back, you lose NOI and ultimately you lose value. So the stuff that you've taken time to create is chipped away at. So I think, in short, for us to get really excited, it would have to be a deal. The basis would have to be very attractive. We'd have to be willing to take a couple beatings over the next couple of years. And it would have to be in somewhere we know well and feel really comfortable with, because I think gone are the days of buying multi, raising the rents tremendously, and exiting at a better price than where you bought it at with, relatively low headwinds. I think it's a fight to the death in the next few years, whether you're in C, B, or A multi. I think they all have their challenges.
Right. Okay,
So
great.
hopefully that wasn't too long, but that's
No, actually, we went through our 3 questions and we have 5 minutes left. But
see, I usually talk too long, and I got it done really quick this time.
there you go. So I guess it's not a question, because I don't want to ruin our 20 minutes, 3 questions, one guest. Can you just kind of give us, some parting thoughts about 24 and being an investor in real estate, whether you're passive or active?
Yeah, sure. Bar none, I still get up every day, right? And I think I have the best gig in the world. And what I mean by that is, real estate, there's only so much of it, right? And at the end of the day, real estate, if you boil it down to its base core thing, whether you're an office guy or apartment guy or retail guy, it's scarcity, right? Land is finite, and development takes that land, and existing land is decreasing as the world's population grows and people develop, right? And that's like an ultra, like, high, 90,000 foot view. But real estate is tangible in a world where things are growing increasingly more abstract and digital. It's a tangible asset class that you can feel and you can go and you can see it. It provides real value. It's the largest asset class in the world, bar none. And if done right, it can be a very, very significant part of your portfolio. You make a lot of money doing it. You can save a lot in taxes for those high AGI people out there. And ultimately, barring a few small blips in history, real estate tends to increase because of that scarcity value. So what we do is we force appreciation and we add value, but real estate is one of the safest investments out there. And there are times where people get wiped out, and you're seeing it in the office market. Some people in multi are struggling. We've even had a couple of deals that have gotten some valuation beat up. But at the end of the day, it's a great long-term inflation hedge. It's a great piece of your portfolio, and it's nice sometimes to not have public market exposure. So we're really excited about 24. I think the opportunities are going to be amazing. Optimism is high across the industry, and we're going to sit here and watch things come back into check, and deal volume is going to pick up.
Well, thank you so much for your insight. I look forward to joining you guys again next month. We will have another special guest on a very, very exciting topic, insurance, which actually is important and really something that needs to be discussed. It's not a topic that comes up often, but it's a very important aspect of owning and managing property, and why and how it's important. So thank you for joining us again, and I wish you all well. And thank you, Frank, for coming on.
Thank you.